In this next lesson of the introductory module of this course, we're going to be looking at part 2 of the sequence of videos on what money is worth, and specifically going into the asking price versus the present value or the intrinsic value of a company or other asset. Once again, I'll give my standard disclaimer. You can certainly look at the written guide, and under the heading Apartments in Korea, WACC, and Present Value, you will see everything that we cover here in the lesson in written format instead. So that is certainly another option. We'll be doing some more Excel calculations here, so in that sense, it's helpful to actually watch what we're doing. But if you want to get the very short version, you can also look at the text as well. Our plan here is very simple because we're just going to cover two things, really. First, we'll recap how to make investment decisions and explain how we'll extend from what we learned last time into what we're covering in this lesson. And then you'll learn how to calculate and use present value and compare it to the asking price of an asset or company to make an investment decision. In terms of how to make investment decisions, we saw last time how there are two methods. You can compare the intrinsic value or the present value of cash flows from an asset or company to the asking price, and you invest when the asking price is less than that intrinsic value. Then the second method is to compare the potential returns to the opportunity cost. And in this case, you invest when the potential returns exceed the opportunity cost. As you'll see when we get to the end, these methods are actually equivalent. Here, we're going to focus on method number 1 and learn how to compare the asking price to the intrinsic value. If you recall, we saw how in the earlier lesson on the time value of money, when we receive back a deposit of $150,000 at the end of 2 years after renting this apartment in Korea, it's only worth $124,000 to us today. So that is the present value. If we invest that $124,000 today at our discount rate, the opportunity cost, it'll be worth $150 in 2 years' time. So the present value tells us what a payoff in the future is worth to us today, assuming that we earn the percentage represented by the discount rate with our money and the returns compound each year. Now, that last part is actually quite important because if you recall, if we start with $124,000 and then we earn 10% our opportunity cost on it, we go up to $136,000 in the next year. And if we earn 10% again, we get up to $150,000 in the second year. So the fact that these returns compound each year is quite important to this definition. So to calculate this in Excel, we can do it in a couple ways. We could use the NPV function, which confusingly actually calculates the present value in Excel, not the net present value. That's something different that we'll get to in a little bit. Or we could do it manually. And the way you could do it manually is by taking the cash flow in the first year, dividing by 1 plus the discount rate. Then you add the cash flow in the second year, divide by 1 plus the discount rate squared. And then you can add it to the cash flow in the third year divided by 1 plus the discount rate raised to the power of 3, or 1 plus the discount rate cubed. The manual method makes more sense when you start to get into scenarios with different timing beyond simple annual periods, or you have partial periods or things like that. But let's go into our file and see what this looks like. So we're going to say that the asking price of this apartment is $200,000 to match up with what we had in our discussion of the apartment in Korea. We'll say that the annual cash flow is $12,000. That's what the rent is. And we'll say that we can sell it at the end for $200,000. So this pretty much matches the numbers that we had before. And for our opportunity cost, our discount rate, we'll go up and use the 2.8% personal WACC number that we calculated previously. So to calculate the cash flows from this apartment, first we start by taking our annual cash flow from rent, and we copy this across through all 5 years. For property sale, we'll enter 0 in the first 5 years. And then in the last year, we'll link to the apartment sale value at the end. And then we can sum up everything here. Now, as I said, there are a couple different ways you can do this. We can use the NPV function and use our 2.8% rate and apply it to everything here. Another option is to do it the manual way and take our cash flow each year and divide it by 1 plus the discount rate raised to the power of the year that we're in. And you can see how this would get a little bit tedious because we don't have the year number in a handy location right now. But if you do that and you sum up everything here, you'll see it still comes out to 229, matching what we got via the built-in Excel function, or at least coming very close. In this case, the investment decision is pretty simple because we just compare our asking price to the present value of cash flows. And if it's less than the present value, then we say yes. Otherwise, we say no. So in this case, the investment decision is a clear yes. And that's pretty much all there is to it, at least for this simple example. The present value or the intrinsic value of this apartment of $229,000 exceeds the asking price of $200,000, so we should invest in this opportunity. Now, there's also another related concept called the net present value, which is equal to the present value of cash flows minus this initial investment. So here, for example, the net present value would be the present value minus the $200,000 asking price. The net present value here is positive, which tells you that you should also invest. Of course, if the asking price were something like $250,000, now the net present value is negative. The present value is less than the asking price, and so we should not invest. The main thing to watch out for is to remember that the NPV function in Excel actually calculates the present value, not the net present value, despite the name. Also keep in mind that if you don't subtract that initial investment, NPV and PV are actually the same. You have to be really careful because sometimes people use them interchangeably in models, even though they're not the same thing at all. There's a lot of confusion because of this issue with the built-in Excel function, so just be wary of that. And before you start saying NPV or PV, see how the person is actually calculating it. And if they are not subtracting this initial investment, if they're only looking at the cash flows from the investment, then it's really the present value regardless of how they label it. So with method number 1 here, intrinsic value versus asking price, the asking price is pretty easy to determine. You can just ask what the price of a house, a bond, or a stock is, look it up in the markets. It's pretty straightforward to determine. For the intrinsic value, you have to calculate the present value of all future cash flows using the discount rate, which represents your opportunity cost for this particular investment. If the asking price is less than the intrinsic value, you invest, which means that you have a positive net present value. If the asking price exceeds the intrinsic value, you do not invest, and that means that you have a negative net present value. Now, you might be wondering about what might cause us to change our minds in this case and say that we should not invest in this apartment. First off, if the apartment's sale value falls, that will often cause us to change our minds. So let's say that we can only sell it for $150,000. Now the present value is $186,000, so it is an easy no decision. If the apartment stays vacant for a period of time and we don't get that $12,000 per year in rent, then we might also say no. So if we delete the $12,000 from the first 3 years here, we get to a no. If we just remove them from the first 2 years, it's actually still a yes. But once we remove rent from the first 3 years, this turns into a no. And if we remove it from years 4 and 5, it gets even worse. If our opportunity cost changes, this might not be worth it anymore. So let's say we get a lot of other good opportunities and our opportunity cost goes up to 5%. It's still a yes, but now if it goes up to 7.5%, it changes into a no. And then finally, if the asking price changes, then this might also turn into a no. So if the asking price goes up to $250,000, you can see that now our present value is less than this asking price, and so we should not invest in this apartment. I mention these because it's really the same concepts that apply to companies as well. If you believe that the company is going to be worth a lot less at the end after you buy it or invest in it, you could turn a yes decision into a no decision. If you believe the company's cash flows are going to get worse, it could also turn into a no decision. If you get better opportunities, this company may not look as appealing anymore. And then if the company's stock price jumps up to a much higher level, then perhaps at that level it's actually overvalued and your investment decision could turn into a no. So that's pretty much it for this lesson. Let's do a quick recap and summary. With how to make investment decisions, you can compare the intrinsic value to the asking price and invest if the asking price is less than the intrinsic value, or you can compare the potential returns to the opportunity cost and invest if the potential returns exceed the opportunity cost. To calculate and use the present value, the typical approach is to project the cash flows from an asset or company, discount them to their present value based on the discount rate or your opportunity cost in this case, and then compare that to the asking price. And if the present value is greater than the asking price, or the asking price is less than the present value, then you invest. Otherwise, you do not invest. And you saw some of the factors that affect this. The asking price certainly plays a role. The selling value at the end plays a role. The cash flows in between play a role. And the opportunity cost, your discount rate, also plays a role. So if any of those changes, then your investment decision could also change very easily. That's it for this lesson. Coming up next, we're going to look at the second part in this and look at how to compare the potential returns from an investment to your opportunity cost or discount rate and how to use that to make a decision.